Hello, everyone, and welcome to the basics of the income statement. Yes, the income statement, the second financial statement covered in Chapter 4. The income statement is probably the financial statement that you will find most intuitive, right? We all have a basic understanding, no matter of our business background, of if I'm in the business of making a good and selling a good or selling a service, then clearly I want to retain as much of those revenues as I can. Right? The income statement will give us a systematic way of classifying costs and expenses that are associated with the revenues generated by the business. Okay, and so ultimately, the income statement or the P&L statement, which stands for profit and loss, will tell us a very important story about the success of the company in doing just that. And one thing I would add here before we really get rolling is that just because a company has negative net income for a given year does not mean that the company can never recover from that. In fact, a lot of companies really struggle their first several years because they can't get what is called scale. They made these investments and they borrowed money to buy these investments, and so they got this debt service, this interest expense, this depreciation, this tax burden, and yet they don't have scale yet, meaning they haven't generated enough units sold to get their profit margin earned to cover those costs. So that's kind of the basic idea here. Okay, so first statement, the income statement is very important. We have to recognize that the income statement will show gross revenues minus various categories of expenses. And there's a reason for all these different categories of expenses. More on that coming up. So broadly, the income statement measures the ability to generate a profit over a given time period. How successful were we at creating revenues and then keeping as much of those revenues as possible intact? Because what we're going to see with the income statement is that any revenues minus expenses that's left over at the end of the year, all that money flows back to shareholders or back into the firm. Flows to shareholders in the form of dividends or back into the firm through the balance sheet under the shareholders equity section. Subtracting expense categories, the different expense categories separately, creates several unique measures of profit. We're not just worried about one measure of profit. I know we tend to just think of net income. Do I have positive net income? That's not the end of the story here, because as we're thinking about improving profitability, we'll want to think about, well, which category should I work on first? Which category gives me the best chance to improve profitability? And so that's one of the benefits of not just lumping all expenses together in one item, one category. Another major thing to note here on the income statement is that it's based on the accrual accounting concept, which means that net income will rarely equal cash flow for the company. So just because we have a positive net income does not mean that we're liquid and we have lots of cash coming in. Sadly, that's not the case. Likewise, if we have negative income, doesn't mean necessarily that we have negative cash flow either. The answer is it depends on what the relationship is like. But remember, accrual accounting deals with that concept that revenues are recorded when they're earned, not when cash comes in. Likewise, expenses are reported when incurred, not when cash flows out. We'll look at a more general income statement shown in a column form coming up. But before we do that, I want to just advance through the decomposition of these different expense categories and line items on the income statement in a very simple manner, tracking the method shown from the textbook. And that is, assume that a company generates $100 in sales or revenues in a given year. Okay, so that's why that first bar has a large length of $100. And then after that, you've got multiple expense categories. First one is cost of goods sold. Cost of goods sold, or shortened by CGS or sometimes COGS as shown here, represents the costs that are directly tied to production. Things like direct material, direct labor. Bottom line, the more we produce, the higher these go up. So we would say they're positively correlated with sales. SG&A stands for selling, general, and administrative costs. These are more like overhead type items, so more like fixed costs, marketing expenditures, advertising expenditures, salaries, maybe even research and development expenses. Okay. So if you look at sales, we're thinking, okay, $100 in sales, that's good. Cost of goods sold 30, SG&A 20. You're down after you cover those first two expense items. You're down to $50 in profit, right? That's left to cover these different costs. And that's the whole point here, is to systematically look at my revenues. How do they change? How do they change and evolve these different measures of profit after I cover these different levels of costs? Really, really important. Next up, after SG&A, we have depreciation amortization. Depreciation amortization reflects amortized costs for property, plant, and equipment that we purchased in previous years, and also the amortization of purchases of brands or patents, or acquisition of competing companies over time. The idea here is that with the accrual accounting concept, we want to match the costs of production as close as possible to the revenues that are earned in the future. And so just because we maybe paid $50 for a certain asset in the past, and that was $50 outflow at that time, what we actually want to do is spread it out over the number of years of which we will earn revenues off of that asset. And so that's what depreciation represents, is a systematic expensing of that original cash outflow. All right, so that's another adjustment to net income and the income statement that will occur to get us back to cash flow. More on that when we get to statement of cash flows. So our first measure of profit shown here in the book after sales is operating income, which is short for EBIT, earnings before interest and taxes. EBIT is a widely tracked measure of profit. Our creditors are really worried about it because they think about it and say, okay, all those operating costs, they got to come out before we get paid in terms of interest expense, right? When the company pays out interest expense, that's interest income to the creditor. So creditors, i.e. banks, watch EBIT very closely for companies they lend to. After EBIT, we're not done yet. We're not down to net income yet, right? We still have interest expense and taxes as well. Interest expense comes out before taxes, which reflects the fact that interest expense is tax deductible. And here we just have taxes of 10, so 40 minus 10 minus 10, and gives us $20 in net income. So that's how we would track in a very simple example, from sales all the way to net income. At that point, the net income can either be distributed to shareholders in the form of dividends or reinvested in the firm. We'll see how that materializes in just a moment. For our purposes, throughout this term, throughout this class, and in fact, for most of your MBA coursework, okay, revenues and expenses will come from going concern activities, meaning product lines or services that the company continues to provide. Sometimes companies discontinue their operations, and at that point, if a company is still generating some smaller levels of revenue off discontinued operations, they may want to show those separate, just so investors or potential investors or creditors, as they're looking at the company's financials and forming pro formas from them for the future, they don't want to incorporate those revenues from discontinued operations. They don't want to set the expectation that, oh, this is going to be an ongoing revenue, earnings, cash flow stream for the company. So I want to spend a couple minutes here talking about these two exhibits that show up in the book. They're really good. And what they're going to do is help you track from net income here to the balance sheet. As I said before, when you have net income of a certain amount, that can go to one of two places: to shareholders in the form of dividends, or to the balance sheet in terms of equity. And so if it goes to the balance sheet, that means that that money is being reinvested in the company. It gives the managers additional capital to play with and make investments with. So if you think about this example here, where the company, you think about it in terms of a water pitcher, In January 1, this company, if you recall, had a balance sheet that showed shareholder equity at $10. Okay. Now, over the course of the year, good things happen. We earned $50 in revenues, let's say. And if we have $35 in expenses, that takes us to $15 in additional retained earnings, right? 50 minus 35 is 15. 15 plus 10 is 25. That's how the money would flow from the income statement to the balance sheet. Our shareholder equity section of the balance sheet will go from 10 to 25, assuming that no payments were made to shareholders in the form of dividends. And so here's another way of looking at this, where we can say, all right, revenues minus expenses, we know that's net profit or net income, right? And so again, assume revenues of 50. And assume now that we're taking all of our expenses, we're lumping them together into one big bucket just to make it manageable to write out in a linear way here. 50 minus 35 again is $15 in net income. And what we're saying on the right-hand side of net income is that net income is the sum of dividends to shareholders plus the change in retained earnings. And again, that's the same thing as saying that net income goes to one of two places. It either goes to shareholders in the form of dividends or it goes onto the balance sheet. Well, if there are no dividends, then what's going to happen is all $15 net income will equal the change in retained earnings. All right. And if we know that our ending retained earnings is $25 and we started at 10, the change in retained earning is $15. And since there were no dividends, all that must have been net income. And I know this example is super straightforward and it comes from the book, but if we need to be sure we can grasp these relationships with simple numbers first. No matter how many zeros are tacked on, the concepts remain the same. We have to know that money that trickles down from revenues to net income can go to one of two places. That's the shareholders in the form of dividends or onto the company's balance sheet and equity. And that's another way of saying this same statement right here. Very important thing to know. And again, we want to make our shareholders happy. We want to pay dividends or we want to build up our balance sheet. Building up our balance sheet through equity often means that we are accumulating more cash on the balance sheet, which allows us to make more strategic investments in the future, which again can lead to growth in our share price, which ultimately makes shareholders very, very happy.